Hey all, another short but super interview today from the Dubai conference I was at, and this one is with George Gammon, who's a fantastic economics and financial investment expert, and he runs Rebel Capitalists. So I'll put a link down below to his channel. Great stuff. But in any case, it's the short, and he goes through some of the key things you need to understand in the markets. And also in the middle, he talks about the cerveza sickness, as he calls it, to keep it YouTube friendly. So very interesting hypothesizing around the origins of that and how it was dealt with. So enjoy. George Gammon, a huge pleasure to meet you. An honor. One of my heroes from Thoughtful Money and Kitco and all the rest. But here we have a very tight time here in Dubai. I've got to run on to the next session in this fantastic conference. So I just want to get around 15, 20 minutes of your top level thoughts. We'll hit geopolitical stuff, but maybe more on your financial expertise, which is extraordinary. So maybe just start with the current macroeconomic, where things are going, what's happening.
Yeah, really what people need to focus on right now is something called the yield curve. So I don't know how sophisticated your audience is, but it's actually, you just look at the maturities on treasuries. So you've got everything from, let's just say, a 1 month treasury all the way up to a 30-year treasury. So this creates what we call the yield curve. And it's one of the most powerful, if not the most powerful economic predictor that we have, period. You go all the way back to 1950, and it has preceded every single recession that we've had. Now, it's preceded every single recession, but you have had a false positive. We had a false positive right around 1967, but then the GDP came down quite dramatically. So you did have an economic decline in activity, but it just didn't go completely negative. But for the most part, it got as close to 100% accuracy as we have in this business of just probabilities. So right now, the yield curve is massively inverted. It's inverted just looking at, let's just say, the Fed funds rate, which is the overnight rate the Fed sets, compared to the 10-year Treasury yield. It's inverted by over 100 basis points. So why that's important, and to give your audience an idea or some context as to why this is such an anomaly. You got to think about interest rates in terms of lending. If you lend your buddy money for, let's say, a week, the risk of you being paid back is relatively low, depending on your buddy, right? So you're going to charge him a lower interest rate than if you were to lend him that money for, let's just say, 10 years. Who knows what happens? Therefore, the interest rate that you would charge would obviously be higher. And this is why it's very natural for interest rate curves to be steep, to go up. So, and this is how banks make money, right? They say they lend, or they borrow short, they lend long. So they borrow with you giving your money, but it's a demand deposit, so it's very short term. But yet they take that money. I won't get into the back end mechanics, but supposedly they take that money. They create money when they lend, but they take money and then they lend it long term at a much higher interest rate, and then they pocket that spread between the asset side of their balance sheet and the liability side, right? So right now, again, that overnight rate in the United States is right around 5.25%. Okay, the 10-year Treasury yield is trading right around 4.1%. So 10 years compared to overnight. So you can see what that's telling you is that the underlying fundamentals of not just the US economy, but maybe even more so the global economy there's a lot of problems underneath the surface of the water. That's what it's telling you. And if you think about the dynamics and the mechanics behind why the yield curve inverts, it makes sense. Because the long end of the curve is all about future growth and inflation expectations. So if these the insiders, I call them the financial insiders, the Paul Tudor Jones, the George Soros, the Larry Finks, the Warren Buffett types, they have access to information that we just don't have, because they know the banksters. They know the CEOs of all these multinational corporations and whatnot. You know, they're rubbing elbows with them at Davos, as an example. So they can sit there and ask the CEO off the record, you know, what's really happening here with the economy? What's really happening with your bottom line? And if these CEOs are telling them, look, it's ugly. It's getting real ugly. What they're going to do is they're going to buy the long end of the curve. Why do they do that? Because they're going to buy treasuries because it's the most safe and liquid asset out there. Whether we like it or not, it is what it is. And then they're going to go out and buy a 10-year as opposed to a 1 month, because if the interest rates go down by, let's say, 1%, if they go down by 1% on a 10-year treasury, the price goes up a lot higher than if you have a 1% decrease in the interest rate at a 1 month treasury. We call it duration. So the longer the duration, the bigger the price move. So they're going to go out there, they're going to buy that for two reasons. Number one, to hedge their portfolio against some sort of recession or hard landing, black swan event, financial crisis, etc. And then they're also going to do it for just straight out capital appreciation. So these insiders get this information that prompts them to go buy the long end of the curve, which creates more demand, which makes the yield go down as the Fed is increasing interest rates, and that's how you get that curve inversion. But the reason it's so powerful and it has such a high probability of predicting a recession is because it's, in my view, it's based on insider information. You know, another example I can give your audience that they'll probably be very familiar with is going back to the beginning of what I call it the cerveza sickness, just to keep it YouTube friendly, because at a time, as you know very well, if we said the C word, you know, your video would get demonetized. So I'll just call it the cerveza sickness. Everybody knows exactly what I'm referring to. So if you go back to August of 2019, we see that the curve actually inverted in August of 2019. And I say, okay, George, what's the big deal? It might have been predicting a recession or something like that, but you can't claim that it was predicting the cerveza sickness. Well, let's think about this, because as I'm sure you've reported on many times, now there's been a lot of reports that have come out by the politicians in the United States claiming that if there was a lab leak, it most likely happened in August of 2019, just prior to their military games, which was supposedly the first super spreader event, right? So let's think about this. Let's just say that you're that scientist in the Wuhan lab, and you drop that vial. You're like, whoops, my bad, sorry. But you know that shit's hitting the fan here, and the probability of this becoming something massive is very, very high. So what are you going to do? Well, if you're in China, you're most likely going to call your local politician, and you're going to say, listen, this is something you need to know about. And then that politician is going to call their local banker, and then they're going to call the next politician, and the next politician, and it just goes up the food chain. And then that at some point, that politician is going to know Jamie Dimon. They're going to get Jamie Dimon on the phone, or they're going to know Paul Tudor Jones. And they're going to call Paul because he's their best customer. And he's going to say, Paul, you need to look into this thing in Wuhan. And Paul, I don't know anything about it. Are you sure? Absolutely. So Paul sends out his analyst or someone that works for him to talk to the scientist directly to get the boots on the ground information. And then they report back to him saying, Paul, this is legit. This is an absolute legit concern. I don't know what the probability is, but it's much higher than 0%. So then Paul says, holy cow, even if this is a 5% probability that this becomes a global pandemic, similar to the Spanish flu or whatever, that the governments do these lockdowns. And keep in mind, he has access to all the politicians as well. So he has access to Klaus, he has access to the global elite, so he knows what the back end agenda is, and he knows that they're never going to let a crisis go to waste, right? So knowing that, if you're in his position, knowing, oh my, if we even have even the slightest pandemic or something that could be viewed as a pandemic, I know what Klaus is going to, he's going to take the ball and run with that, for sure. I mean, this could lead to tyranny, authoritarianism, lockdowns, all this stuff. And if that happens, the markets are going to view that as deflationary, obviously. They're going to view that as a black swan event, something that could, that could be the end of the world, for all we know. In that case, I'm buying treasuries because they're going to protect me. And if this pans out, then I've basically got a call option because I can hold these treasuries and just collect, let's say, 2 or 3%. And if this does pan out, then they're going to massively go up in value and they're going to protect the rest of my portfolio. You see, so when you look at it in those terms, you see why the yield curve has been so accurate. And then we fast forward to where we are today, and we see that the yield curve is inverted just between the overnight rate and the 10-year treasury by over 100 basis points. And you say, okay, well, this is the market, the insiders, not just telling us, but showing us what they're doing with their own money. And if they're doing this with their own money, it means that they're very, very scared, or they see the probabilities of a recession hard landing being extremely high. Now, that's not where the story ends, though. So for your viewers, just understanding that the curve is inverted, that doesn't give them really any timing, right? So it's like, okay, I get it. There's some storm clouds on the horizon, but what do I do with that? Like, how does that help me? So that's when we have to go back and look at how it usually plays out with the timing of the recession. And it's very rare that we have a recession when the curve is actually inverted. It actually happens after the curve is no longer inverted. I always use the term uninverted, and I don't even know if that's a word, but it best describes it, right? So the curve uninverts, and that's when the stuff usually hits the fan. So if I'm an investor trying to use this as information that's actionable, I'm going to sit there and watch the 2-year and the 10-year as an example, just every day. It's super easy. Anyone can do it. It takes 10 seconds. You can look at CNBC charts. And I'm going to say, okay, I'm going to watch that curve. When the 2-year starts going down, 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 down to a point where it's under the 10-year and it stays, now all of a sudden I know that that's when I should be maximum risk off. Or if you want to be like the insider, that's when I should be long the TLT or the 10-year or the 30-year. Or what I said in the presentation the other day, I like the 2-year treasury because you don't get as much bang for your buck, but there's a much higher probability that it goes down with the Fed dropping rates. And the curve normally uninverts because the Fed's dropping rates in response to a recession, to a response to the unemployment rate going up, to a response to the GFC, the dot-com bust, etc. That's usually what uninverts the curve. So we call that a bull steepener. And what's really cool about the curve is you know if it's wrong. It'll tell you. And so if the curve is wrong and that the probability of the recession starts going down, then what happens is you would see the long end of the curve, the yields, start to go up and up and up to the point where that's what created the uninversion. So we call that a bear steepener. So when the 10-year, let's say the 2-year stays fixed right now, let's just say it's 4.6%, right around there. So if you see the 10-year start going up and up and up and up and up to the point where, let's say we fast forward a year, and now Fed funds is still at 5.25%, let's just say the 2-year is at 6%, and the 10-year is at 6.5%. Well, now all of a sudden we've got an upward sloping yield curve, which is what it should be in a normal, healthy economy. And that tells us that, okay, we were, the red flag that we were waving for the last 2 years, you don't have to worry about it anymore. That all the smart money has determined that the probability of the recession is very, very low. And therefore, what they've done is they've taken their money out of treasuries and they've allocated it somewhere else that makes more sense from a standpoint of risk reward because the risk has gone down. And therefore, since that capital's come out of the long end of the curve, that's what makes the yields go up. And again, it's future growth and inflation expectations. So you just watch that like a hawk, and there's a very high probability that we get the bull steepener. That's when you should be maximum risk off, once the curve uninverts as the Fed drops rates. But if we get the opposite, that bear steepener, that's when you know that maybe it's something where I should say, okay, this time it's different. That's good. And then maybe I should look at more opportunities in risk assets.
Excellent, George. And my follow-up question was, of course, for the ordinary person, but you already answered it without me asking. So we're tight on time. That was beautifully summarized. And I guess for the ordinary person, if you're in the market and your pension now, I guess you hold on and watch carefully, but it's not really in general a good time to jump in now in general sense.
Yeah.
But maybe hedging with metals, maybe gold might not be a bad idea, at least with a percentage, rather than being completely out of that space?
Well, I think that everyone should always own gold. It's not even a matter of price, because for me, I don't even see it as a investment. I don't see it as a speculative asset. I just see it as an insurance policy. So if I get an extra $100,000, I just allocate 10% of that to buying my insurance policy, which again is gold. But keep in mind, gold usually goes down quite a bit when we have a recession. Why? Because it's doing its job. So gold's job is that you can always sell it. It always has a bid. But unfortunately, what happens, all these hedge fund managers or pension funds or whatever it is, they hold gold for that reason, for that insurance. So when the stuff hits the fan and they can't get a bid on anything else in their portfolio and they need the liquidity, they don't have a choice. They're going to sell gold. And because it's doing its job. And that's why after Lehman Brothers, if you look at a chart of gold in 2008, you see the price just collapse. Same thing with the cerveza sickness in March of 2020. Look at the price of gold. Same thing. It collapses. When there's a liquidity crunch, people sell the only thing that's liquid, right? But that's your buying opportunity. So I'm not saying, so if you're a speculator or a trader, okay, you might want to wait until that curve uninverts and then gold gets super cheap, go in there and buy, and that's your opportunity. But that's just looking at it from a standpoint of a trader. If you're just a normal average Joe and you're not trying to time the market or whatever, yes, I absolutely think it's paramount that you should always just own gold. But if you're just looking at it as a speculation, you might want to time it with that curve.
Absolutely, George. Primarily, I got in for the first time into gold later in 2020 after that dip, so I was kind of lucky. I wasn't planning on being a speculator. I was just becoming aware of the importance of the metal. Just one last question on that, though, and then we are done. In the past, it may be a different this time scenario again. I'm conscious the last few years, the central banks and the BRICS, etc., are piling up on gold.
Yeah.
So I wonder this time, will there be maybe less of a drop in gold when the shit hits the fan? Because the likes of the owners like central banks now don't really need to sell it. Is there an element of that possibly slightly dampening the drop in gold? Just a thought I had.
Well, it's interesting. There could be the opposite argument there, and that the float of gold is lower than it otherwise would be, because that's now on central banks' balance sheets, so it's not going to circulate, assuming that they're not going to be a seller or they're not going to be a buyer. And therefore, the current gold price, let's say at 2,100, let's just say it remains flat for a while, that tells you that there's an equilibrium between demand and supply. And so if we have less and less supply out there due to central bank, let's say hoarding it, for lack of a better term, or siloing it might be a better term, that means that the demand is actually a lot lower as well, assuming that the price is staying the same. So you decrease the float, and therefore that's going to increase the volatility. So what that means is if there's just marginal buying, the price is going to go up a lot higher. But if there's marginal selling, then the price is going to go down a lot lower as well. So it very well could play out the way that you're describing, but just be careful with that, because it could go the opposite direction real quick as well. You could catch that air pocket, because if the float is lower because of that siloing, that would increase the volatility of the asset price itself.
So there's a little bit of amplitude effect there that could jump either way depending.
Yeah, again, the way I'd look at it really is the physical gold. Don't even worry about that. That's just a part of your portfolio always as insurance, regardless of what the price is doing. But if you want to get cute with it, and if you want to use this as a speculative play, then I wouldn't really look at the price of gold. I'd look at the miners. Because also the miners right now, relative to the price of gold, are extremely cheap.
So leverage.
Yeah, so if you want to play this from the standpoint of a speculator, then you say, okay, I'm going to go ahead and wait for that curve to uninvert. The Fed drops rates the first time. I'm going to wait for that liquidity event. Assuming we get that liquidity event really quick, then if there is a low float, that's going to dramatically impact the price of gold, which really should translate into the miners, which are already cheap. They get even cheaper, and that's when I come in with my liquidity, my dry powder, and I buy those gold miners and sit back and wait for the government's response. And the government's response, the central planners really, the central planners' response is always positive for gold, and therefore will be super positive for those gold miners that were already cheap relative to the price of gold going into the hard landing.
Excellent, George. Well, personally, I'm just holding what I have. I'm not a person lucky enough to have assets that I could use to jump on that curve. But listen, thanks so much, George.
Yeah.
A privilege to have met you, and hopefully again soon.
Yeah, thanks for having me.
Thank you.
Great guy, George, and I'll be meeting with him and many others in Orlando. They want me to come over at the end of May to the Rebel Capitalist Live conference, and I'm going to be speaking there and meeting up with some really interesting people. And as mentioned, we also discuss gold there a bit. I often mention that, and my affiliation with Pure Gold in London in the UK. I feel quite strongly about gold. It's been rising a lot recently, though it will move up and down, but it's a serious hedge. So if anyone is considering looking at hedging somewhat with physical gold, Pure Gold in UK, there's the link down below, and you'll get a free year's storage if you want to decide on whether to actually take it into possession yourself, which I would tend to do. And there's also a free consultation with their financial experts in general finances beyond physical metals. So there you are. It's there if you want it. And till next time.